You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO, This Week in Futures Options, a program where pretty much the name says it all. We break down the week that was, and in many cases still is, on the futures options side of the fence. Maybe we'll talk some gold, some crude, some ag, some equities, crypto. You never know what's going to make it onto the old spinning wheel of fun that is TWIFO. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. Love the steady stream of new folks who continue to discover the stuff. It's great. Been around for 11 years. Always great to have newcomers checking out the fun stuff like TWIFO. You guys know how to get it all, of course. The archives, the deep dives, you want to go to the website or indeed to our mobile apps. Got everything in there. All of our shows going back 11 plus years now. If you want to just have it subscribed, delivered to you on your schedule, iTunes, Pocket Cast, whatever you like on that side of the fence, Google Podcasts. We don't judge. We don't care. Whichever one you like to use, go for it. Even the much maligned Apple Podcast app, which is, shall we say, wonky. But people like it, so let it go for it. Of course, you can always join us live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern via Mixlr, MIXLR. Grab that link once. It's good to go for TWIFO. It's good for VolViews. It's good for Option Block throughout the week. It's good for all the live stuff we do, the surprise interviews here from the studio, all sorts of fun stuff. So grab that link, follow us in Mixlr, and you'll get notified the second we go live, not just with TWIFO, but with all of our other fun stuff throughout the week. You never know what's going to be coming into our studio, so keep an eye, or should say an ear, on that one. Of course, however you listen, live after the fact, hit us up, questions, comments, insights, all that fun stuff. We do like to hear from you guys. And I am joined, as always, on the old TWIFO program by my futures options compatriot, Mr. Nick Howard, the founder over there at Bantix Technologies and creator of a little platform we like to use around here called QuickStrike. Mr. Nick, welcome back to the program, sir.
Oh, is it Friday already?
It's hard to believe.
Quickly.
The week flies by. So it seems like we just talked like an hour ago and we're talking again. Crazy.
Yeah. No, well, we got some good stuff today, I think. So look forward to it.
I'm looking forward to it as well. Our new cohort couldn't be here yet again. He was sick earlier, traveling again. So Mr. Sean Smith, of course, from FTSE Russell. We'll get him back on next week to talk a lot more fun stuff going on. A lot of stuff cooking in the equity space. We'll get to those in a little bit. But first, we are also joined, holding down the CME hot seat this week. We actually have two guys, so they're just fighting for space in the same seat. Hopefully they're comfortable throughout the entire show. We have Eric Baum, the senior commodity trader, and John Rothstein, the chief operating officer from Optiver US. Guys, welcome to the program.
Hey, Brian. Excited to be here.
As we are wont to do with all of our first-timers here on the network, why don't we go ahead and have you guys give us a little bit of an overview of your backgrounds in the space and, you know, what it is you guys do day-to-day over there at Optiver. Maybe, John, we'll start with you, then Eric, you can jump in after him.
Thanks, Mark. John here. So I've been with the firm and in the industry for about 11 years. Kicked off my career as an options trader here with Optiver, S&P options, gold options, FX options. It seems like a lifetime ago, though, so you're not going to hear any keen insights from me on those products probably anymore, certainly not for this week in options. After that, I took on a couple of different managerial roles, different kinds of education roles here with the firm in all of the offices across the world. And now, more recently, as the COO, I'm responsible for a number of things like market structure clearing, business development, the legal group, all sorts of things. So I've been in the industry for that long, seen a lot of it from a couple different corners, and that's what I do now.
And Eric, same question for you. Give us a little bit of your background and what it is you do day to day over there at Optiver as the senior commodity trader. I think your title says it all, but give us a little bit of insight into that.
Absolutely, sounds good. So I joined Optiver 6 years ago out of school where I studied economics. After doing a brief stint trading index options, spent the large majority of my time trading various commodities, so crude, nat gas, and the last 3.5 years focused on agricultures and launching our soft commodities desk, so trading sugar.
Sugar. There we go. Well, ags are indeed going to be the focus again. You guys loved it when we did a nice deep dive into ags a few weeks back on the program, so we thought we'd go back in, and thankfully a lot of things are happening in that side of the fence. So we'll kick things off over there. As always, you guys can follow along with the show, not just live via the Mixlr link, but you can also generate your own reports over there at cmegroup.com/TWIFO, TWIFO. Head on over there and make sure if you're listening live, you're fine. If you're listening after the fact of the podcast, make sure you change the settings on the report so you can see exactly what we're looking at here on the old program. Of course, you can get all the fun stuff we're talking about here, the open interest, the vol, the skew, all that good stuff here on the old program. So guys, like you mentioned, we're going to do a little bit of a deep dive into ags. You know, a lot of things are happening. Maybe I'll let you guys spin the wheel for us. Is there a particular product out there on the ag side that's really catching your eye right now you want to sink your teeth into first?
I mean, they all actually have been pretty interesting this week. Obviously, we could start with corn. It's been, the most liquid product, say, the last couple of years. There's actually been a lot of interesting trade going on there of late.
Oh, yeah, well, we can get into that then. You're right. Corn is, you're right, has been an active one this week coming in, finishing the week off about 10 handles, a little bit more on the farther out in the term structure, about 15. We're right around 10 handles, right around 380 here coming in to showtime. Before we dive down into some of the vol and the other stuff that's going on out there, open interest-wise, Eric and John, what have you guys been seeing out there in corn? What's really been catching your eye in the corn markets of late? Of course, it's a hot area with all the talk of tariffs. Will they, won't they? A lot of action. What have you guys been seeing?
Yeah, so from, an order flow standpoint, there's been a lot of back month call interest. So the SEP 450 call, you see that as one of the big interest strikes on quick strike. So there's been outright SEP 450 call buyers. There's also was a large SEP 450 $5 call spread buyer. So even though the futures have been ticking down, there has been a lot of upside interest.
Yeah, that's not surprising. In fact, you mentioned the quick strike. Let's break it down right now here. We're looking here again. You guys can generate your report to cmegroup.com. /TWIFO was an interesting week. Vol, kind of a bit of a mixed bag in the nearer portion of the curve, up sharply, which is something that it needed. If you look at a lot of the data coming out of, I think, in fact, CME puts this out, I believe, as well, looking at implied vol kind of across the ag complex. We're seeing averages in terms of like 6 years. I don't care where you're looking: corn, soybeans, wheat, soybean meal, soybean oil. Current vol levels well below what we're seeing for 6-year averages. A little bit of that changing coming into the end of the week, so maybe we'll get a little bit of a lift out here in vol. Certainly a little bit of a bump towards the end of the week out here in all things corn vol. I'll let Nick get into the skew and stuff in a little bit. In terms of what we're seeing out here in terms of action, actually open interest was a pretty strong week as well, up about almost 7.5% out here in corn. The big month, the lion's share coming actually in July with about 32% of the OI here. But it's kind of bifurcated trading here between, as they were just alluding to, between the SEP and indeed the July. Is that a typical structure? I know the ags tend to trade a little bit differently than a lot of the other ones, where the lion's share of their volume is going to be in maybe the front month, something like that. The ags are a little bit more bifurcated. They like to spread out their liquidity a little bit. So, Eric, is this a typical setup we usually would see in corn, where a decent amount, about a third of the action in the front month, and then another third about a few months out or so?
I think especially as you're entering near the summer months, you're going to see players who typically like to reside in the front end of the curve, but you're also going to see players who are speculating / hedging exposure during the volatile summer months.
Mr. Nick, I know you got some burning questions.
Yeah. Okay. Yeah, I wasn't sure if it was on. I just pinged you at Skype, and it's still going through. Yeah. So, fellas, I got a couple questions for you. So, interestingly, you said back month for September. I traded the Eurodollars, and it's funny because back month SEP was really not considered so much a back month when you're talking about June. But I want to ask a couple of questions, and for my own edification as well as for the people that are listening. And Mark alluded to it. You can see just by the volume in the open interest where a lot of the trade occurs. But I was just wondering, do you see much outside of the new crop option? Like, are you in the 2019? Are the short dated trading all that much? I don't see much volume or open interest in the weeklies. So are we still sort of? I mean, this you're looking at 2, 3, 4 months generally, where I'm assuming you're making markets and everything, but just kind of give us an idea of where the action is most of the time. And another thing that I really kind of wanted to get from you guys is, Optiver is a market making firm, but the reality is, markets will set up or the vol will set up or the vol curve will set up to the point where you might, like a position might be something that you put on. So without kind of, divulging your secret sauce so much, if you can tell me, where, do you see much trade outside there? You're making markets, but do you ever just put something on because you like the way the curve is set up?
Yeah, no, we're definitely seeing, trade across the board. While it's predominantly in the front end of the curve, so your front month July, SEP, DEES, we are seeing some activity in the short dated. So there's actually been a bit of short dated July and short SEP interest. We think the short dated is actually a pretty interesting contract because it gives, potential exchange customers an opportunity to, trade a nearer term option while having that exposure to, in the corn's case, the DEES future. So we are seeing a bit of interest. We've seen short July upside interest, some put interest last week. And then there was actually a short July seller, a straddle seller on the screen and an outright seller in the pit yesterday.
Yeah, and that's I'm glad to hear. And again, for us that don't have experience in those markets from a trading standpoint, and now at this point we're observers in most of the markets, at least the market and I are on the show. From that show standpoint, and we're looking at the numbers, but have the experience to sort of disseminate the numbers and have some insight into the numbers. But yeah, I would imagine that the short dated, it's because in the interest rates they do have the mid curves, the same thing, and those have just tremendous amount of open interest and volume. So I would think that it's just a better way to get lower premium exposure, but to the same underlying movement, and to play because nobody likes doing I don't know. Right now, December is like a 168-day contract. There's premium involved when you're purchasing out that far. I mean, I know there's still a lot of open interest, a lot of it's hedged, but I would just think that would be something that would have increased volume as people become more aware of it. You guys, market makers, obviously are, but maybe the general public needs a little bit more of a push. And then my other question would be, Mark and I are always intrigued as to why the weeklies just don't seem to have the sort of action outside of like the treasuries and the S&Ps, and occasionally when we get around OPEC and stuff like that, or some other EIA number in the crude. You guys have any insight as to why you think the weeklies aren't necessarily, trading with the amount of action that you would expect, especially when you get the kind of the moves you have over the last, week or so?
It's a good question. We have really been actively quoting the weeklies, both on the screen and in the pit and in the broker market. We are bullish that the volume can pick up, especially now that we're entering the summer months and there's been a lot of macroeconomic events. So in the treasuries, the weeklies were a really nice tool because there's so many different macroeconomic events. There's Fed events, there's economic figures coming out throughout the weeks. There's also global macro events. So pretty much like every other day, there's a major event. So the weeklies are a really nice tool for traders to be able to hedge that exposure. In ags, now that we're approaching the summer months and there's a lot of weather events, and now we have the China tariff news, and this past couple weeks there's been also the plummeting of the Brazilian currency, which has caused some price action. We see the weeklies as an interesting option for traders to look at.
Right. So to go back to a previous question. So do you guys, are you purely making and taking, or do you ever say we like something? Because one thing that I think, being off the floor and being out of trading for a while, I realize a lot of the you make markets, and a lot of times you get stuck with crap, right? I mean, that's what you end up doing. But do you guys ever look at something and say, I like this, and sort of put it in a separate account and kind of hedge that as a different position, or is it just really a global book that you're taking care of?
That's a good one, Nick. I'll pick up this one because the answer is going to be, for that particular question, it's going to be the same for all of our asset classes, more or less. So one of the things folks probably who work at competitors of ours, they'll know that, when you're trading, either you take on something that you don't want, or just by virtue of being in the markets all day long, you form opinions. And even if your mandate is market making, in and out, high volume, low risk, it's impossible once you've been trading in the markets for a long time not to develop some opinions. And so what we've tried to do, just as we've specialized quite a bit, and I imagine our competitors have as well, we have researchers, we have quants, we have data scientists, we have developers, we have traders, we have back office. Whereas when I started, a lot of that stuff we actually did, the traders did themselves. So in furtherance of specialization, we even like to have groups that themselves are sort of like prop groups within the trading team. So even though we're a market making firm, what you want to do is, at least what we think we want to do, is we want to specialize the folks who say, this is where we think the level should be, this is the place where we'd like to put a position on, and then we kind of separate that to some degree within the firm, and that guides us on our macro pricing. And then the market makers, those who are tasked with, capturing the bid-ask spread, maintaining high volume, understanding how the algorithmic side of things works, they sit a little bit closer to moving in and out of positions. And those two types of trading kind of feed off of each other. In a way, the prop desk is quite like market making, just with a wider spread on it.
Right. No, that's I'm sorry. Go ahead. I apologize.
I was just going to say, and then to some degree, it depends on which desk. In the case of actual ags and some of our other products on the commodity side, what we do is we actually tie up those prop traders directly into the market making desks. And in others, it's truly a standalone desk, and they're making decisions sort of independently, let's say.
So within the ags desk, I'm actually focusing on the prop positional side of things.
Right, because I would imagine that, just again, I just was trying to look at interesting things in corn to take a look at. Like right now, let me pull it up. This we're kind of tilted. The skew's pretty. I think I pushed out a report. Where do I have that? I mean, the corn calls, 25 delta calls, are very rich right now in comparison to history. So, you could easily be making markets and getting hit on stuff in an upside where somebody on the prop desk would want to sell that at the same time. So, I'm glad to hear that there is some separation, because I feel like in the old days, and when I say old days, I'm saying in the 90s, we didn't do much of, occasionally we called it like an offshore account. Occasionally you'd pull out some teeny and you'd put it in another account because you thought there was a chance, or it was so cheap that you just didn't want to. If we moved the market in one direction or another, you didn't want that to affect your deltas, right? So, but I think we didn't do enough, and it's only after years of retrospect that I realized that some of the things I did to take positions off is probably when I should have probably kept those off and managed those separately myself. So it's refreshing to hear that you guys are doing both of those at the same time.
You know what, and one thing, if you guys don't mind me piling on, the specialization in the trading side is also fed by the fact that the tools that the traders need on the IT development side are quite distinct. And so although market making, the algorithmic side is much more, what do you want to call it, let's say resource intensive than the prop position side is, still they need different things to be able to visualize what they want, to be able to capture the right trades. So the specialization of the trading side of things also benefits the specialization of the IT side of things, that the traders who are specializing in one type of trading can work together with the IT teams to make particular tools that suit what they need to do. And so in general, like I said, that's not special to ags in our company. That's truly the way we attack it on all of our asset classes.
It has been fascinating to watch all this going off right now here in corn. Corn, of course, kind of setting records this week with the futures hitting a record here of, let's see, I have it right here. Here we go. Futures open interest surpassing 2 million contracts. That was actually back yesterday, 2.006 out there. Previous records, actually, the first time it's ever hit 2 million contracts. Previous record not that long ago, June 4th, 1.99 million contracts. So not surprisingly, corn is pretty active. We talked the tariffs before. There's a lot of events actually kind of popping off right now that are kind of driving a lot of interest in all things ags right now. We got WASDE coming up on the 12th, which is, of course, the World Agricultural Supply and Demand Estimates. Said that 5 times fast, I dare you. Then coming up on the 15th, we have the weekly options. Week 3 is kind of getting back to Nick's point before about the weeklies. It is surprising that we're still not seeing as much driving the weeklies, given the fact that these quote-unquote deadline for the Chinese tariff self-imposed there is on that same day, June 15th. We got, of course, expiration coming up on the 22nd. And then the 29th after that, we have the acreage reports coming out there, as well as, of course, we have expirations out there in the weekly. So it is still a bit of a head scratcher. You know, John, you're a market structure guy. You've kind of been around the space for a little bit. Do you think maybe it's just a structural issue? Again, we kind of postulated on the show before that maybe there's something systemic with the brokers, that in terms of how they're displaying these, they're not really surfacing the weeklies yet to get the action. Because, you know, as Eric alluded to, you guys are quoting them pretty actively, so it's not a liquidity thing. So it's got to be something else. What do you think maybe is really lurking behind the scenes there that's keeping a week like this? The corn weekly should be lighting it up, and yet we're not seeing that.
Great question. Probably difficult to surmise what's going on there. I think it depends on what the end users are using the contracts for, and it could be that the end users of, you know, agricultural and commodities products don't have the same short-term risk coverage as a natural part of their business. And I understand that I'm speculating here, but you can always go back to what the CME's end clients want. And it's either folks like financial firms or hedge funds that are putting on positions where they see good chances to drive profit, or it's the hedgers and the commercials who are needing these products to make sure that their core business is running smoothly. And so why don't people find as much interest in the weeklies and the commodities and the ags as they do in, as you guys put it earlier, the S&Ps and the rates? It very much likely has to do with a hedging operation not needing as much short-term risk coverage. Probably better to get one of those folks on there to answer without speculation, but that would be my best guess.
Yeah, you know, we've had a lot of different people on the show over for a while now, people at the exchanges, at the trading firms, at the brokers, at the other desks. We've heard a lot of different speculative ideas. It's the same issue, actually, for the weeklies in crude, which is kind of interesting. It makes me think it's something more systemic going on. Maybe it is an issue with how these things are surfaced or something like that, where, because in environments where you should see a lot of, and people will trade the front month all the way down to the final week, so they will trade short duration stuff. It's just, it's got to be something systemic going on. We'll get to the bottom of it one of these days, Nick. It's kind of our ongoing mystery out here in the futures options land. What isn't a mystery is what was lighting it up this week in corn. Eric kind of alluded to it a little bit earlier. We'll just run it down really quickly here with our top 5. We've already been talking corn for a half an hour. That's how much stuff is going on in the ags this week, listeners. Number one with a bullet out here in corn this week are the 400s coming out here in July, as we kind of alluded to earlier. It's kind of a little bit of a bifurcated list this week. July 400s taking the top spot, just a hair under 50,000 contracts, lighting it up. The lion's share coming on Monday, actually, with 20,000 contracts, 10,000 on Wednesday. The rest kind of scattered throughout the week. Then we jump on out to SEP, as we alluded to earlier. It's kind of all over the place, which is kind of a bit of a hallmark of the ags out here. The SEP 450s, as we talked about earlier, doing 47,000 contracts this week. The lion's share, actually almost a tie between Monday and Tuesday, 16,000 on Monday, 15,500 on Tuesday. The rest, again, kind of scattered throughout the week. About almost 10,000 of that opening, actually, on the week. So a lot of opening positioning, alluding to those spreads and verticals that Eric was talking about earlier here on the show. Then we jump right back again to the front month, and we go down to the dark side, to the puts, the 380 puts, doing about 26, almost 27,000, about 12,000, almost 13 coming there on Monday. The rest kind of scattered throughout the week, about nearly 6,000 closing on the week. So some maybe closing downside positioning. Maybe some people got spooked about the tariffs and then afterwards decided discretion, the better part of valor. Who knows what was going on there, but still a lot of closing positioning over there. Then we draw off a little bit again to number 4, which are the 390s. Also again out there in the front month, doing about 24,000 and change. The lion's share coming on Monday with about a third, about 8,000 going up, about net 1,600 opening over there again. A couple more to round out our top 5 here. Let's go out to Dees. Dees 450s doing about 23, almost 24,000 contracts as well. So as we kind of alluded to, that 450 strike is where the action has been. About 8,000 going up on Monday. So a lot of upside, perhaps in the near, not too distant future, at least options wise here out here in corn. And rounding out our top 5. We go back here, actually, looks like to the front month, to the, actually, no, we're going to go out to set, and we're going to go to these 410s, doing about 18,000 contracts, the 410 calls. Again, over half coming on Monday, nearly 10,000 of that coming on Monday, and a lot of that opening, about 7,000 contracts total on the week opening. So kind of a pick-em week, mostly calls with some puts filtering in there as well over there, an action-packed week for all things corn. Nick, any last thoughts on corn here, sir?
Yeah, I got a couple general questions. John, you did mention how the weeklies in your answer, how it depended how the people were using them from what their hedge window was and stuff like that. But so I'll give a two-parter and you can answer. So one is in relation to the weeklies. So I got to imagine that there is some speculative market out there in the ags for all the products. So, for me, and again, as Mark said too, given the move that we've had over the last several days with this, they just seem like a natural, cheap way to get in the market and to play a direction. So I'm curious as to what your take is on overall speculation in the ag market as opposed to just from a producer hedging and the buyer hedging and stuff like that. Secondly, I wanted to just get an idea. There's been a lot of back and forth. Sometimes there's angst and other times there's positive statements about the block market in the ag. So are you guys obviously taking part in that? How do you feel about it? Those kind of things. So if you can answer the second one, great. First one, like to get your take on that. Second one, just get somebody else's perspective because I just have, listen to brokers that I'm talking to and also following what's going on in the blocks. More and more is happening out there. So just like to know what you have to say about that.
Yeah, thanks, Nick. I'll do it in reverse order because I'll let Eric talk a little bit more about the price action and the interest in the weeklies. Your second question about the blocks, and this is something that we watch with a lot of interest, as you can imagine, because we are there to provide and partner with the CME and provide prices anywhere that they want to show to their clients and their customers. And it's they're the ones facing the customers directly. We're sort of behind the scenes partnering with the CME. And so if the CME has determined, and of course their competing exchanges as well, have determined that this is a way that their customers want to transact, that's based on research they've done, and then we are there to provide prices. And I'm not going to act like we haven't heard some of the resistance. We've also heard quite some positive stuff about it. And I think the answer to that question is that each type of transaction, like medium, let's say, is not for everyone. And I think it's probably in the CME's interest, and obviously I can't speak to it better than they can, but it's in their interest to provide products and venues that cover all of their current and potential customers. And so although you might find folks who are upset about the way a block is rolled out, you're going to have a ton of folks who are interested in trading it. And Optiver's job is to be there to provide prices in any of those venues. Now, I'd say, I don't mind addressing the elephant. Some folks are worried that in the block market, the prices aren't hitting a club and they're not lit. And one of the things that we always try to explain to the CME so they can explain it to their customers, and it would be the same for any competing exchange as well, is that a firm like Optiver needs to have all of the pricing information centralized. And that means that no matter what type of trade venue it comes through at, we centralize it in our pricing model, and then we redistribute it back basically on the nano or the microsecond anyway. And so for anyone who's worried that a block trade is not contributing to price discovery, it's simply not true. And I can understand why they think, but that would mean that there's someone who's using a block is doing it in order to remove it from lit price discovery, and that's just simply not the reason people use those things. So that's a bit of my answer. I totally understand when people are not happy about a new trading venue. Some people could say the same thing about the pits or the screens or the phones. There's always resistance to a new thing, And you know what? If the end user wants to do it, and we can partner with the CME and provide prices for their clients, then that's the way I think that the market structure should develop. So I hope that answered the question on that one.
Yes. And before we let Eric jump in there on the weeklies, that was basically what I was trying to get at. Was the complaints you hear is that there's a perception with the people that aren't necessarily participating in that market that the pricing is off, but there's no way, just having experience in it and having been down there and been part of it and been watching it in the other markets for so long, I just didn't see that as being something that was necessarily feasible. So it's really, to hear it from your perspective and the fact that it's all integrated as part of the regular market making and pricing structure, it makes no sense that it would be disjointed from what's actually happening in the market. So thank you for that answer very much. Now, Eric, if you have like an answer on the spec weekly thing, that'd be great to hear as well.
Absolutely. So there definitely has been some speculation, not to the extent you may see in the front month like you alluded to, but as there is bigger one-way price moves, and as you approach the weather, summer weather events, we are starting to see more weekly interest, both in the pit and on the screen. There are brokers who are trying to shop these weekly orders, and who are typically trying to push them at least once a week. But we're definitely open to continuing to push the product, push the liquidity there, and generate more education surrounding them.
We could talk probably corn the rest of the show, but I want to keep on rolling, make sure even our other ag junkies want to get to some other ones too, and we have some other products we want to squeeze. It's amazing how an hour flies by when you're talking all things futures options, but it wasn't just corn that was lighting it up in the ag space this week. No, soybeans also having big moves going on. They were set for a while there for the biggest weekly loss in about 10 months, since about back in August of last year. Round out the week off about 50 or so handles, right around 970 here in the beans. So an interesting week out here in soybeans land. Again, a lot of this driven by the back and forth, will they, won't they dance that's going on the tariff side of the fence. All this leaning in towards the vol popping back up here out here in soybeans land, which is probably a good thing if you're looking at some of these charts out here of how current vols, at least coming into the middle of the week, versus 6-year averages we're looking in soybeans. Soybeans had one of the most glaring discrepancies there. The vol probably roughly 2/3 now of what it was on the 6-year average. So probably a little bit of a room for vol to move there on the upside. Before I do a breakdown here, maybe Eric or John, obviously big week for soybeans as well. What was going on? What was catching your eye out there from an options volume, from an OI, and from, of course, a volatility standpoint out there this week? Yeah, from
just a fundamental standpoint, it was pretty interesting. So the Brazilian currency, the last week and a half really plummeted, and yesterday was a pretty large downtick. So that, coupled with the China, tariff speculation, we think led to some downticks in soybeans. There was a lot of put interest in the front end around this time, so it's no longer the front end, no longer the downside, but the July 980 puts, for example, the 970 puts, the 990 calls. There was a lot of actually interest on both the July $10 calls and the $10 puts. So there was a seller of the July $10 puts the last couple of days. So there was a lot of interesting activity in terms of the option option activity. In terms of the vols, they started catching a bid yesterday and today surrounding a lot of this news. So the front end vol is up quite substantially over the last 2 days, close to 3 points.
Is that a welcome development for you guys, or are you guys wanting it to linger here a little bit long? I mean, whenever vols lingering in the doldrums, you'd be probably saying to yourself as a market maker, I wouldn't mind a little bit of a juice coming back in here, but sometimes if it comes in too rapidly, that could also be problematic. So is this, you like to see a little bit more juice back in soybeans right now, Eric?
Well, I'll jump in. It's John. It's a little bit dangerous, of course. We love vol because we're volatility traders, but oftentimes heavy vol, as you guys know, comes from adverse price movements. So you're towing a fine line between saying more vol, more vol, more vol, and understanding that might be causing pain for folks' 401ks. Ags works a little differently than kind of some of the basics, but just something to note. It can be a tightrope there.
Yeah, we saw that demonstrably in the equities a few months ago. Everyone all of 2017 was talking about, where's the vol? Can the vol please come back? And then when it came back with a vengeance in February, and all of a sudden people were saying, well, that's a little bit too much vol. So yeah, sometimes how quickly it comes roaring back to life can be a bit of a pain point out there. In terms of what was lighting it up, Eric kind of broke it down for us, those 1,000, those 10 puts out there lighting it up in July. It was a tight race this week, one of the tightest we've seen on TWIFO for our number one spot out here in soybean options. The July 1,000, as he refers to it, the $10 puts out there, taking the lead by just the nose. 20 contracts for the number one spot, 22,492. The lion's share actually coming on Monday with 6,000 and change, going up kind of even throughout the week, except for today, kind of anemic, only 1,200 hitting the tape today. A lot of back and forth, as he was alluding to, a seller. Obviously, other traders coming in because the OI is pretty much unched on the week. So with 22, almost 23,000 contracts going up, not much to speak of in terms of changes. OI shows it was a very hot strike out there, and that's kind of to be expected. These round number strikes drive a lot of interest, a lot of action. And whenever we're floating around it, that's where we're going to see a lot of interest. Number two, 20 contracts less, 22,472 of the 1020 calls. So it wasn't all puts all the time. There was some upside. Now looking very distant upside, 50 handle away upside. Was a lot closer earlier in the week there, with about the lion's share coming on Wednesday, 5,600. The rest kind of evenly scattered throughout the week. Again, a similar story, only a couple hundred contracts net change to the open interest. So just back and forth, frenzied trading pretty much across the board out there. Number three, the 980s. Again, as Eric alluded to, coming in number three, 18,000 and change. The lion's share coming on Monday, 4,000 contracts going up there. Maybe some verticals. Maybe Eric can speak to that. A 980, 1,000. Monday, the active day for both, so maybe a little bit of trading. They were out of the money puts until recently. Now they're in the money puts. So funny what a difference a day or two makes out there. Again, this is a little bit more biased towards closing, about 3,700 net closing out there over there. Then we got to roll out a little bit too. We got a lot of products still got to get to here. 980 puts out here in August, also active, about 17,000. The lion's share actually yesterday, nearly 8,000, so a little almost half going up yesterday, about 2,400 net opening. And rounding out our top five here in all things soybeans, actually going out a little bit. We're going out to November and to the upside. Nova 1100s doing 16,000 contracts. The lion's share actually coming yesterday, Thursday, 6,000 net, about 1,400 closing. So it's a bit of a mixed bag out there, which is kind of interesting, a sign of a pretty frenzied week out here in soybeans. Open interest up about nearly 4% on the week. Mr. Nick, what's catching your eye out there from a vol and from a skew perspective out here in soybeans this week?
Yeah, I mean, I'll make my observations, and then I'd be curious to see what the guys have to think here as well. So, I mean, one thing, Eric and John, that we watch quite a bit is the skew, right? And we typically are looking at the 25 delta skew, and Quick Strike has a measure we call quick skew, which basically normalizes the skew against the at the money. So it's more of just an agnostic percentage as opposed to like a volatility percentage. So it's just a percent difference from the at the money. And it looks like we have a tightening of the channel over the last week in terms of the difference between, it's more of a balanced smile now on the vol curve. Before we had, a week ago, we had pretty sizable bid in the calls and a pretty good offer in the puts. But that channel has tightened quite a bit. And then historically, just based on looking at the charts, and I just tweeted it out if you happen to be following live, when we start to get the calls moving towards the put here, we see them kind of maybe stick around next to or close to each other, maybe even cross for a little bit. And I'm looking at the 30-day constant maturity. but we tend to always move back out. So, I mean, are you guys just, again, without, I understand the market making firms, you can't say so much about what you're doing or what you're looking at, but I mean, are you as part of the prop process, you're looking at you're looking at the skew, and you're looking at how the vol curve is shaping up, looking at that historically, and then kind of making some of your prop decisions on that? Because I certainly always kind of address when we get to the reason quick skews are on is to address the extremes. So when the calls are super expensive and the puts are offered, or vice versa, there's obviously risk reversal or call put spreads that you can do to put on delta neutral risk reversal, that type of thing. So are you guys looking at that stuff? Anything you're seeing, Eric, specifically about skew that you like in the beans that would start to alert you towards paying attention to maybe a move in one direction or another?
Yeah, you definitely, were correct when you mentioned, skew has moved to the downside the last week or so. It's been really pronounced in the front end of the curve, which makes sense on these, pretty large downticks. As on the prop side of things, and just even in our basic market making activity, we're constantly looking at skew levels, how skew is performing, also comparing it to historical levels. So those are all things we are looking at to help us better market make, and also to potentially take on positions when we see fit. And we'll also be looking at skew in one expiry versus the other, in relative plays.
All right, great, perfect. Yeah, so you guys got people out there listening, you can look at the feed and you'll see that I did the 1 year worth of soybean 30-day constant maturity quick skew. Take a look and you'll see it on the option. It'll be mentioned with ad options and at CME Group. So if you're interested in seeing that. And you could also, for people who are listening, and Mark, we forgot to mention this early on, I left the live links on all week again, but while we're going on, and I'll leave them on over the weekend for everybody too, you can go to the quick skew number on the TWIFO report and click on the link, and you'll be able to see the charting for all of the stuff that we're talking about today as well.
Very cool. Very cool. I like all of that. I'd love to keep talking ags. I'll give you guys, Eric and John, give your voices a little break here for a few minutes as Nick and I dive into a few other categories that I know our fans would get upset if we didn't hit on as well. Let's start with the equities. Our buddy Sean over here couldn't make it from Russell, so we'll do our ableist in his stead to dive into kind of a funky week for equities. I'm not sure how much you were watching, Nick, but it's kind of all over the map. The vol, the underlyings, was kind of a pick your poison week, depending on which index you're looking at is where the action was completely different. You had some days the S&P was unched and the Dow was up and the NASDAQ was taking it on the chin, and Russell was kind of moving to its own beat because they all kind of moved to different stuff. Russell, of course, we've said before, one of the things that attracts people to it is, of course, the fact that it's somewhat insulated from some of these macro shocks going on when you're talking about tariffs and other big macro global events, because it's primarily small cap, which is in the name. So you get a lot more insulation from those macro trends, whereas S&P large cap, those are much more affected by these the winds of change out there on the political seas there. So a lot of interesting things going on, and we saw a lot of that going into this week, where vol is kind of moving all over the place differently. Even today, intraday was a weird story for vol. We saw in the morning vol was kind of spiking across the board, S&P and in the Russell. Then now as the day is kind of moving on, we're seeing the vol kind of coming in. Russell vol, which you guys can always follow along just very easily. RVX, they quote it for you. It's the VIX of Russell. Everybody knows VIX as the S&P, but there's also a Russell VIX. Ticker is RVX, right around 14.5 right now, which puts it about almost 2.5 handles higher than VIX cash itself, which is something to keep an eye on. You know, we've always said that before. For if you're looking, people are always lamenting when equity vol gets low. Where's the vol? We want vol to come back, and we're starting to flirting with those territories again as we're getting into the low teens in S&P vol land out there. So Russell gives you a nice little boost there in terms of a few vol points. So that's where you're looking. That's where the interest was. In terms of the action out here in Russell options, actually over there on CME, actually another pretty active week, Nick. OI growing steadily every week, up about almost 16% again this week. The index actually settling up about 20 handles net on the week. So a good week for the bulls out there. Vol, of course, coming in, as we mentioned before, net on the week. The action is a little bit interesting. We closing out the week right around the 16 70 or so handle. And yet what was dominating the tape this week, Mr. Nick, were calls, pretty far upside calls as well. These were the AUG 1800s. Taking number one with a bullet out here. I probably wouldn't have guessed that if I was asked off the top of my head before the show. Coming into, of course, you can't talk. We were talking weeklies before in the ags. You can't really talk equities without talking the weeklies. That's where so much of the action is. And number two out here in the Russell this week was indeed in the weeklies with these June weeklies doing 1670 puts. Taking the number two spot out here. So kind of a bit of an interesting week. I'm just looking for some weird aberrant paper before you dive into the skew, Nick, because I know we gotta keep rolling. 1,200 puts, lighten it up and SEP a little bit. So not all bullish upside listeners. You got a small print going up on these 1,200 puts out here in SEP as well. So kind of a pick your poison week out here, Nick. Way upside calls, far out on the money puts, some more at the money puts. Kind of a all over the place. 1,700 calls. Lighting it up here in July as well. So all sorts of weird stuff. Anything weird catching your eyes? Like I said, it's been a weird week for skew and for vol across all the indices. Anything catching your eye out there in equity land this week, Mr. Nick?
Yeah, I mean, like we talk about it, and I'll do a comparison to the Russell to the S&P from a quick skew standpoint. So, in the contracts, under 30 days, it looks like we didn't have much go on in the skew. We had the calls get a little less offered than they had been last week at the end of last week. But other than that, nothing really substantial. You mentioned 16% increase in the open interest, and we're seeing the same increase in the open interest in the S&P this week. As far as the comparisons, again, we've been talking about it since Russell came back on board. The puts are definitely still much more bid in comparison to the at the money in the S&Ps than they are in the Russell, and the calls are definitely cheaper in comparison to the at the money than they are in the Russell in the S&Ps. So kind of the similar movement in the skew this week for the S&Ps. Got calls a little less cheap and the puts a little richer, but really not much of a change. So even though we have a move in the futures price, we really we didn't have much. We talk about that local movement and volatility along the vol curve. This week looks like we more slid that was more of a sliding vol curve along the futures movement. So that's the one thing we kind of see in this market, right? We see that vol curve slide where in the WTI, which I cannot even believe we didn't even talk WTI this week because they had such a big move and it's such a change in direction of the market. But the WTI, we sort of see the at the money, we see the volatility sort of slide along the curve, and we don't see much of a parallel shift in that curve. But in the Russell and the SPUs here, it looks like we're seeing that curve slide back and forth along with the future. So not much crazy difference in the skew. Sort of similar. We're still seeing, I think early on, Mark, we saw the Russell kind of tied more closely to the S&P in terms of the richer cheapness of the puts and the calls to the at the money, and we've seen a little bit of a divergence here. And it could very well be that the Russell market's more stable, more stocks trading in that, so there's less of a worry of the big downside move. But that's about what we're seeing here today.
Yeah, we can't not hit WTI. Our listeners would revolt, Mr. Nick. So I'll do a quick rundown on WTI, then we'll get to some questions. I want to make sure we get some questions on the show. We may have to run a few minutes late here on the show. Much to talk about on this. That's why we need to make TWIFO 3 hours coming up soon. So much to hit. But Nick alluded to WTI, another crazy week. We saw the trend, interesting what's going on there. Lots of trends going on out there. We talked last time about the WTI Brent spread. That kind of got out there to about 11, which everyone thought there was going to be a soft cap on that. It's kind of come in a little bit since then, but it just craziness going on out there in the spread, blowing beyond most people's expectations out there in terms of what was going on with the spread. The crude actually setting out the week off slightly, about a half a handle or so, pretty much unched on the week. So not a lot of people would have expected that at the end of the day. Crude vol also coming in a bit after having gotten a little elevated, still mildly elevated compared to where it was a few weeks ago, but off a bit off the recent highs. Number one with the bullet really quick out here was the July 64 puts. So slightly out of the money puts, doing about 25,000 contracts out there. We also saw some action in the 75 calls out here in Dece and in October. So 75 strike also where a lot of action. If you're feeling super bullish, you're not alone. Someone picking up or trading at least about 3,000 of the D's 2019 par calls, 100 calls, lighting it up out here this week. Also 4,200 going up in D's 2020. I'll have to check. Maybe there's a little bit of a block, maybe a bit of a time spread going up there, Mr. Nick. Or people just love themselves some par across the board. D's 2019, D's 2020 par calls. Where the action was this week in crude. Now, speaking of action, you guys have been hitting us up. We got to get some of your questions. It is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. You guys hit us up. We try to answer as many as we can. We also promised last week we would pay off this vol question, so we'll do it this week here on the show. We asked you guys last week which of these products you think have the highest 30-day implied vol. A little bit of a challenge with Bitcoin, I know. So let's talk realized. I know, but still, we'll play along here. The big debate we asked you guys to pick. You guys actually chose Bitcoin, 35%, 34% choosing Tesla. I think you guys let their volatile reputation perhaps confuse you a bit. 21% saying VIX and 10% saying the Russell 2000. Mr. Nick, what did we decide on for the regular average vol of Bitcoin?
Oh, what do we have? Let me look. I gotta look. I didn't have it up. I'm sorry.
That's right. The answer is VIX. The VIX is about a 90, right? A little bit north of a 90. You can look at just VVIX. That'll tell you. So volatility of VIX is gonna win. But Bitcoin has spiked. I could see why you guys would think that has spiked well over 100 at times. So I could see why it has this connotation of being super volatile. And yet over on an average, Mr. Nick, it's somewhere around a 65, right?
Well, it's been trending lower. I think right now, if I'm looking at the daily historical volatility over the last. Well, I got a 30-day chart here that compares the daily change in prices, a 60-minute change in price over a similar amount of time, and then a 15-minute change in price. And to be honest with you, I mean, we've been rangy for quite a bit in the Bitcoin, and what we're seeing, I'm seeing about a 50 vol in for the daily, and then really dragged down in the 15-minute and 60-minute vol changes. So we're seeing a steady trend down in the at the money and in the realized volatility. And like we said last week, you go out on Deribit exchange where they're actually trading the Bitcoin options. We were in line with our short-term change volatility was in line with about where that stuff was trading. So we're sitting on a pretty tight range right now. We haven't had big jumps, and I think, when's the last time we were outside like the 7,000, 7,000 range? We're at 7,500. I know you're getting $200 and $300 moves at times, but it's dampening the volatility quite a bit here.
Yeah, so a long way around to saying Bitcoin, all you guys chose it, but it actually is number 2. VIX, number 1, right around the 90s. Bitcoin kind of just broke it down for you. Number 3 would be Tesla, right around the 43 or so level. And Russell coming in, right, we just mentioned it, right around a 14, 15 or so. So number 4 there. A little bit of a confusing one. We like to throw you some brain teasers every now and then. All right, so you got a bunch of questions here. Let's see if we can surface. So I got a bunch of ag ones here, too, so hopefully you Optiver guys are ready to answer some questions here. Let's start with Toni. Wants to know, I've been listening to TWIFO since the launch, along with Vol Views and Advisor's Option. Well, clearly a man of good taste. He goes on to write, thanks so much. Thanks. Easy read to read. Thanks for so many hours of listening and learning. Well, you're welcome, Toni. He goes on to write, I think I have a problem with TWIFO, though, because you guys are slowly luring me to the dark side of ag products. Well, he's clearly been listening. He uses my terminology, Nick. But I'm not really sure where to begin because I'm a complete novice when it comes to agriculture. Puts in parentheses, mostly trade SPY and single name equity options. Is there one product that you feel is the most friendly or the least intimidating for beginners? Also, are there any good resources out there for budding ag options traders? I have some ideas on this, but I'd be curious. You guys are knee deep in the ag trenches over there every day at Optiver. I'm sure you've come across similar questions, maybe from friends or family in the past. If you had to point people in one direction, and maybe they're coming from the equity world and they want to wrap their heads around one ag product to start trading the options or maybe the futures on, where would you send them? Which product would you point them to?
Absolutely. It's great to hear that there's new participants interested in the CME Ags product space, which is awesome. It's a good question. I think corn, in terms of the liquidity, the tightness of the markets in the option space, and I'd say also the liquidity in the futures is a logical product to start off with within the ag space.
Yeah, I was probably going to lean that way as well. It's hard to argue with that. I've seen anecdotally a lot of guys I know who are professionals who have migrated over into the ag options from, let's say, trading in the equity options exchanges. So these are professionals who know options, and yet they're all neophytes when it comes to the ag products. And most of all of them migrated into corn just for the reasons you just mentioned, the liquidity across the months, deep and liquid. It performs probably some of the most, nothing's going to be identical to an index or an equity, but it has some of the more similar leanings, shall we say. So you're not going to be totally, at sea like you are if you're looking at, let's say, I don't know, a livestock product or lumber, which is kind of just trades on its own rules of engagement. Mr. Nick, you agree with that?
Yeah, I mean, these guys will know, like I always say, we're outside observation people more than anything else. But I would, Eric said it earlier in the program about the liquidity in the corn being so good. So that probably makes the most sense, the best for new people, tighter markets, most liquidity in case they're wrong or they have a problem, and probably more information about that particular product than wheat or beans, and probably more. And you guys, you correct me if I'm wrong, probably more local than, the corn is more of a local market as opposed to the beans where we have the global participation. Would that be accurate?
Yeah, definitely more so than a wheat, for example.
Yeah. Let's see. We should wrap it up, but I'm feeling so generous to the listeners. We'll do one more. We're up against it, but it's so much fun, and we want to keep the party rolling there. We'll do one more. JLM4 wants to know. I see a lot of talk about spreads between similar commodities, and he has here WTI Brent, KC wheat, Chicago wheat. He has a bunch of examples. He goes, what about spreads between different commodities that may move in accordance to similar fundamentals? Is anyone tracking these relationships? He puts here, for example, WTI gold or gold and the 10-year. And are there any relationships you guys watch regularly that are outside the established intra-commodity spreads? Great question here, JLM. We just talked about WTI Brent a few minutes ago. We talked about gold, silver before. You're right. There are these very established relationships that everyone watches and that we track, and that they have actual futures and options trading on to track the spread. So those are clearly well established, but maybe there are some more esoteric ones out here. How about you? Since you're our guest, I'll give you guys pride of place. Maybe a dubious one on this one. Well, we shall see. But an interesting question. You guys, Eric and John, you guys have any, when you're out there obviously making markets, you're tracking liquidity across a broad spectrum of products. Are there any interesting relationships you guys have noticed and started to keep an eye on that may be informative to other products, maybe that people wouldn't expect?
Great question. I mean, it obviously, to be able to do that, it helps if you have a wide product suite. And Optiver being sort of, one of the market leaders in all of those products makes it possible, and it gives us a lot of insight into the product flow. Eric would know better on the ag side. We don't, I think, have a lot of ag cross-asset vol spreads that we trade. We do, Eric?
Yeah.
Very good. We certainly do for things like rates, FX, definitely across the different index equities. But I will kick it back over to Eric, and you can talk a little bit about the ag space then.
Yeah, so like John alluded to, that's one nice thing about Optiver, being, a top market maker across a wide array of products. We're really able to try to bring all of these different products who have varying degrees of correlation over time together and use them a bit as signals. So actually this past week, off of the Brazilian currency news, soybeans and sugar actually were ticking down pretty much in tandem. So at times, some of these products can behave similarly, and the volatility can also behave similarly across the term structure.
Mr. Nick, any funky relationships you've noticed over there in all your years of parsing the data on Quick Strike?
I don't know that I'm watching the cross product or even cross asset class correlations, but I will tell you just to let people know that are listening, there is a cross correlation tool available as part of the tool set for free out on the cmegroup.com/quickstrike page. So take a look out there and you'll be able to see a year's worth of correlation. It'll tell you, what's moving together, there's no relation, or what's negatively correlated. And you can also click on those numbers to see the history of that correlation as well. So that will be my input to saying that if you want to do some investigating yourself, head on over to the Quick Strike page on CME Group and you'll find that tool available.
All right, everybody. That music means, unfortunately, I tried to press it as long as I could, listeners, but unfortunately, we've come to the end of another epic journey to the world of futures options. Oh, what a journey it was. We covered so much ground. A lot of ags, corn, soybeans, a little bit of WTI, a little bit of equities, a little bit of other stuff, a little bit of crypto even sneaking in there as well, intercommodity spreads. We touched it all on this show. I'm sure someone's going to write in saying, what about this one? So no, people always want what they want out there. Keep the questions coming. We'll get to more of them on the next show, I promise you. Jam-packed one this week. Before we go, let me go back around the horn, check in with my cohorts, my partners in crime, see what they have cooking that may interest you. We'll start with our guests here over there at Optiver. Guys, if our listeners want to learn more about what you guys are doing, maybe you have some white papers, some research you guys are putting out that's of interest, or maybe, who knows, maybe they're intrigued by the world of market making, liquidity providing in ags and other products, and maybe they want to research a career. Where should they go? What should they do?
Best way to do it is to get in touch with us directly. We also have a website that can direct them for careers. To be honest, if there are participants out there that want to learn more about blocks and what kind of liquidity they can find, they can always call us as well. Mark, I'm not sure if you have my contact info, but I'm a great person to get in contact with, and I can kind of direct the people from there depending on what they're interested in, whether it be ags, blocks, careers. I know everybody here at the firm, and we can do it that way. We're always looking for great traders, always looking to learn more about what the end user wants so we can provide better liquidity through the CME and other exchanges. And that's a little bit about us.
There you go. So hit up John directly. You can hit us up. We'll forward it to him for you there. Of course, we want to talk about the ever controversial, ever interesting world of ag blocks. Who knew block trading could be so exciting and controversial, but the ag world has it in spades. You can learn more about all the things these guys are doing over there, including the career stuff. Optiver, that's OPTIVER.com. And while you're at it, give them a follow on the old Twitters there at Optiver US. There's different versions. Optiver US is the one you want to talk and follow from these guys. And of course, Mr. Nick, what is cooking in the realm of all things Quick Strike, sir?
What do we got cooking? So Sunday night, Monday, you're going to see the new shorter mid-curve options available on the Eurodollar. So those will be out there. Those are 3, 6, and 9 month mid-curves for the DC March and June contracts. So if you're trading rates, now you have more ability to trade those fourth quarterly and then the first two reds out there, because we lost a lot of liquidity once that front red rolls off at the end of the week. So that's coming out. And then what else is new? And like I mentioned before, I can't say anything still, but keep an eye out. There'll be a big new tool release coming pretty soon, and it's going to be pretty interesting and very geared towards a lot of stuff that we talk about here. And, if you got any questions, you can reach out via Twitter or shoot us a note from the website. So that's about it.
I forgot the last part of Tony's question here. He asks for good resources for budding ag options traders, for budding ag, crude, energy, equities. I don't care what your poison is. Head on over to the CME Institute, the formerly Futures Institute, now rebranded CME Institute. Talked to some of their educators recently. They have a lot of cool stuff going on over there. So you can find that, of course, over there, cmegroup.com. While you head over there, head on over to cmegroup.com/TWIFO. Follow along with the reports and good stuff. Then click on over to Bantix, BANTIX.com. and sign up for the full thing yourself. And on behalf, of course, also our friends over there at Russell.com to learn more about all the things going on in the indexes. They know they have the big reconstitution coming up as well. Actually, it's FTSE Russell, FTSERussell.com to learn more about the reconstitution. We'll get Sean in next week, talk more about that in a lot more detail. And on behalf of Nick and our guests, Eric and John, and indeed myself, and of course Sean, who's going to be here next week, I want to thank all of you and our friends at CME. I want to thank all of you out there for downloading, streaming, and subscribing, for sending in such great questions. We'll try to squeeze in more next week. I know you guys have a lot of questions. We'll get to them. And we'll see you next time for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.